What's up, guys? Welcome back to Everyday Money. Now, I just got done recording another video, and I've been thinking about this housing thing that people are always talking about. I see it on the internet all the time, waiting for the crash, waiting for, whatever to buy a house. And I've had some ideas on this, and everything's already set up down here in the old basement studio. So I grabbed a fresh cup of coffee and just said, F it, we'll do it live.
Do it live! I'll write it and we'll do it live!
Do it live! I'll write it and we'll do it live!
Well, not exactly live. Obviously, it's going to be edited and recorded and whatever, but you get the point. The deal is, though, is that all the time I hear people talking about how they're waiting for the housing market to crash before they buy a home. And because we've been in this bull run of housing since like 2009, when housing ended up bottoming from the Great Recession. And there's a lot of reasons for why things have been going on in this bull run like this. Housing prices have been going up. One of the biggest is that housing starts have just not yet caught up with demand since the housing market all came crashing down. Another big one has been the coronavirus pandemic. People wanted to buy houses. They want to have a place to live. Millennials hadn't been buying houses for the longest time, and now they're getting older and have the money to buy houses. They want to buy them, and this coronavirus pandemic just made it even more of a priority. And there's just not enough supply to fill that demand. The coronavirus pandemic made it even worse by raising lumber prices with all the mills and the factories closed down. No one working, no construction workers working on these projects, and just making the supply problem even worse in the face of insane demand. And in the end of that, everyone is saying that they are waiting for this crash because they lived through this crash once before. And I'm pointing at my computer screen that's just slightly out of the camera view that we're going to get to here in just a second. And I want to just say that I don't think that there is going to be another crash like the 2008 crash in our lifetimes, for us that are millennials and the people that are right behind us. And I am one of the older millennials, and actually I wasn't even included in that until they started pushing back the dates from the late 80s or early 90s back, and they've said that now essentially anyone born in the 80s is a millennial. But coming up on 40, I'm one of the older ones, and so I got to live through 9/11. I got to live through the coronavirus pandemic, the housing credit bubble crash, and I just don't think that's going to happen. There's a lot of reasons why I think that, including lending standards are much tighter than they used to be, and that is the biggest one. We're not doing these loans where they're not verifying income, where they're not verifying assets, which they call the ninja loans, the no income, no job or assets. They didn't verify any of that. They just took you at your word, and they handed out loans. They handed out loans on homes that did not appraise. They were doing these crazy drive-by appraisals and whatever. But even when you look at the housing crash that we had in 2008 and into 2009, the prices didn't even go down by that much. And over the course of time, I think that crash is just going to blend into a little blip on the map. So what I want to do is I am actually going to start recording this on my screen so that we can both see the same thing all at the same time. And we'll take a look at this. And what you're looking at right now is the median sales price of homes sold in the United States by the St. Louis Feds. This is the official data, and it goes back to, let's see, Q1 of 1963, when the median home sale price was $17,800. And as you can see, as you go up this chart here, this isn't even exponential growth. And it may be a little bit, but for the most part, this is a almost linear growth chart in the value of the median sales price of a home. So it's really hard to even make the argument that this is really taking off in a way that is not sustainable. And what I really want to focus on is the 2008-2009 credit crash, the housing bubble crash, and how much that actually was, in just some myths and truths about it. Because in 2007, Q1 of 2007, home prices peaked at that point at $257,400. And over the course of the next 2 years or so, a year and a half, 2 years, home prices plunged down to $208,400. And lots of people lost their jobs. Lots of people laid off. There was lots of foreclosures. Major financial institutions that were hundreds of years old folded, and it was not a great time. But when you look at the total value loss in homes, you went down to that $208,400, and that only is a $49,000 loss in the median price of homes. And now granted, that's a lot of money, but it only comes in at about 19% drop from its highs in 2007. And if you look at that amount of money financed over 30 years for the 3.125 that you can get right now pretty easily in the middle of 2021, you're only looking at $209.90 a month. And so that it's not a lot of money really when you look at having a mortgage and having a home, paying utilities and upkeep on it. And the thing that I want to get at is that this market will never come down permanently. It won't. If you bought a home in 2007, you would have been made whole somewhere around 2013. So trying to buy this dip and trying to wait for this crash that I don't really think is ever going to happen is probably not a good thing, because if you were doing the same thing back in the early 2000s and you were like, well, this has been on a bull run since 1990 was the last time it had really dipped in a significant fashion. You're like, well, I'm going to wait and I'm going to wait, and the housing prices keep going up and keep going up and keep going up. You might have got something here in the .com bubble burst, but you would have missed all the rest of these gains that we had through here. Again, as it continues to go up and continues to go up until here, and now it's at a peak and it starts to crash out. And then this is when, so it crashes like this, and now people don't buy because now they're afraid that home prices are going to go down permanently. They're going to go down forever, and so they get scared and they don't buy. So it starts coming back up, but everyone now is saying it's going to crash again. And that has been the refrain since the housing prices hit that 2009 trough, is that every year, Michael Burry and every other pessimist, every other bear comes out and says the market's going to crash again, the market's going to crash again, the market's going to crash again. And the deal is that even a broken clock is right twice a day. And we haven't had a significant crash in housing prices since then. There have been some blips. 2017 we had this little blip here and here, and then the coronavirus pandemic hit, and housing prices are way up here. So the key to this is just like any other investment, the market always goes up. The housing market always goes up. And the reason is because inflation. The inflation will always exist, and it's not necessarily a bad thing, because the 2 to 3% inflation that the Fed shoots for, that keeps people buying things, keeps the economy running. And now there have been other times where there's been hyperinflation, or not hyperinflation, but accelerated inflation up to the mid-teens, and we could be going into that right now with the amount of money that the government has printed for all these stimulus bills, for all this coronavirus relief. We could be looking at a much higher rate of inflation. But if we look here like the S&P 500, even though there are dips and there are crashes and corrections, the market has always gone up, and in this case it's in an exponential fashion where there is this curve to the chart and not just a straight line. We can look at the Dow Jones as well. This is another thing where it's never going to go down permanently unless there is some major catastrophe and the United States essentially does not exist anymore. So the deal is that the time in the market beats timing the market. So if you can afford a home now and you want to buy a home now, and that is important to you, and having a place to live is important to you that is your own, because really when you look at a home as a total investment, and I'll put a link to another video I did on this, is that it is basically a wash. It is not a good investment, as most people say, as most real estate agents like to say, as the real estate industry likes to push, because by the time that you buy the home, you maintain it, you upgrade it, because a lot of people treat it as a fancy toy, just like I do. I have a very nice home, and it doesn't make really any financial sense, but it's what I like. And although this channel is mainly focused on investment, and I try to maximize my returns all the time, my home is my home, and that's what it is to a lot of people. And so by the time you get your average 3% rate of appreciation on your home, then you take out the 3% of inflation that is the norm, you end up with a wash at best. And then after you take into account your ongoing maintenance and things like that, it usually ends up being a loss in the end. But timing the market is not going to get you somewhere. So if you're ready to buy and you're waiting for a crash, you could be waiting decade. Again, like we look at here from 1990, you could be waiting 17 years for the crash to happen, and then you may be then scared to buy, and then even when the crash happens, within 6 years the home value is right back to where they were before. The worst real estate crash recorded on this entire chart. And then, you know, we've been on a tear since. So we have been now on a tear since 2009. So we are in now a 12-year tear of this real estate market. So even if we do come down, you know, 19% again, or 20% or 25% in the next, 5 years or so, the chances are that you will be made whole within, the next 5 to 10 years after that. Now, there's no way for me to predict the future, and there's no way for anyone to predict the future of where things are going to go. And I'm not a financial advisor. I'm not even a realtor. I'm just someone who has owned homes since 2006. I invest in real estate, and I have a lot of experience in this. So consult your own realtor, consult your own financial advisor about what you can afford and what you guys think the realistic prices are going to be. But the idea of waiting for the next crash with a totally different set of regulatory rules, lending rules, and just the fact that I don't think that the federal government will ever let 2008 or 9 happen again because of the massive fallout from. I think they will just throw money at any problem. That is the reasons why I don't think that waiting for a crash is a wise thing to do. Leave me a comment if you disagree with me, or if you agree with me, or whatever, down in the comments section there. Be sure to hit that like button if you like this video, if you got some value out of it, if this maybe helped you make your decision. Again, not your financial advisor, so you guys need to do your own research on this and see what works for you. Be sure to subscribe if you haven't. Grow your wealth, increase your success, put you on the road to financial freedom. I appreciate you guys watching today, and I'll see you in the next one.